In this video I will be going through a worked example on partnership ledger accounts, starting with the general journal where you have to journalize the adjustments and closing transfers and thereafter post into the ledger. Now strictly speaking, you're supposed to journalize the adjustments, post those to the ledger, then journalize closing transfers and post those to the ledger. But the way I will do it is I will do the whole general journal first and thereafter just pick up some of the general ledger accounts. Alright, number one, they give you some balances. That's what you're going to start your ledger off with. Okay, one thing I just want to stress here, the drawings of A and B represent what they have already taken from the partnership during the year. And then in the profit and loss account, that figure there is your net profit amount. Right, the first adjustment tells you that partners are entitled to the following monthly salaries. Now bear in mind you're doing this for the entire year. So when you are doing your entry for this, you must multiply each of the partners' salaries by 12. The double entry you need to make to record that will be to debit the salary of A, which is an expense to the business, and B, and credit to their current accounts because that increases the earnings of each of the partners. Adjustment number 2 tells you partners are entitled to interest on capital at 10% per annum. Obviously you just take your capital figure here, 300,000 times 10%, and likewise 200,000 times 10%. The double entry you make to record that one will be to debit interest on capital, which is an expense of the business, and that is the total of the interest for A as well as B, and both those amounts go to the partner's current account. Now those are your year-end adjustments. If there was a bonus, you could also have a bonus in here. Number 4 is actually a closing transfer, but before we can do number 4, we need to close off other accounts first. So the first thing we need to do is we need to get this net profit out of the profit and loss account into the appropriation account so that it can be split up. So you're going to debit your profit and loss account, that was to close that account off, and credit the appropriation account. Remember your final section accounts, the debit side is the expense side, the credit side is the income side. So the appropriation account starting off with that credit total which is on the income side. Now that net profit first of all gets used for the partner's salaries and interest on capital. Now if you think about it, salaries has a debit total here. When you're closing off an account, you need to make the debit and credit side equal, which is why we need to credit the salaries and credit the interest on capital, and both of those will end up on the debit side of the appropriation account, which is your actual expense side, like I mentioned a little while ago. Now if you look at this net profit here, minus your salaries and interest on capital, that will give you whatever profit is left over, remaining profit. So to do the entry for that, then you're going to need to take it out of the appropriation accounts and record it in their current accounts. Now to calculate that amount here, let's just look at the ledger account because it's easier to see. We started off with the net profit. We used that net profit here for the salary of A, 36,000, the salary of B, 33,600, this interest on capital of A plus B of 50,000. So your remaining profit was 5,400, and in the question they tell you at the top here that the remaining profit needs to be split in the ratio of their capital balances. So their capital balances are 3:2. So over here you're going to take that remaining profit of 5,400, give 3/5 to A and 2/5 to B. And that will be this entry here. Can you see that it's going to end up on the plus side of current accounts because the business made a remaining profit? If this figure here, this 119,600, was more than this 125,000, then you would have a remaining loss, and this JV number 5, the entry would flip. So you would debit their current accounts because it's a loss, it decreases what they've actually earned during the year. Then the last thing we need to worry about is we've been using drawings during the year to record everything the partner's taken. What I've done now is I've given them what they were entitled to. So the last thing I need to do here is I need to close off their drawings account to their current account. Drawings has a debit balance brought down, so to close it off you have to credit it. That's going to end up on the debit balance of the current account of each partner, which is a minus side because that's the part of their earnings they've already taken. Now I use two different colors here. The red is for the adjustments and the blue is for the closing transfers. So you need to read what you're required to do in a test. They may ask you to do the adjustments and closing transfers or either or. So you need to know the difference between the adjustment entry for salary, which is this one here, and the closing transfer entry salary, which is this one here in blue. Alright, then just to go through a little bit of the ledger. Once you've got your general journal right, your ledger is straightforward because you do exactly what the general journal tells you to do. So for example, the first one here says debit salary of A, credit current account of A. So we credit the current account of A and we debit the salary of A. Then we do the same for B. Then interest on capital, you need to credit the current account of A and B, and interest on capital needs to be debited with the current account of A and B. You see you're writing the name of the contra account here, the other account that contains that double entry. Alright, then you would go down to the appropriation account before you do this entry here for 2160, because that's a calculated amount. So when you're closing off accounts, as I said, you need to make debit and credit equal. So at this point, for argument's sake, in the salary you've got a debit total. To close it off, it gets credited. Likewise, interest gets credited. Double entry rule then says whatever you credit, you must debit the same amount in another account. So can you see how there's a double entry for that 33,600. There's a double entry for the 50,000. Okay, and once again, I told you this is the income side, the credit side. That's why the profit's there. This is the expense side. What is that profit used for? Salaries, interest. And then this figure here was where we calculated the 3/5 for the one and 2/5 for the other. So if you're debiting the appropriation account rather, then that means you're going to credit the partner's current account. And then the last thing you need to worry about is the drawings. At this point here, this drawings account is a debit balance brought down. To close it off, we make debit and credit equal. So you need to credit the drawings account of A and the drawings account of B. Double entry, if you credit here, you're going to debit there. Now, if you think back to a previous video, I explained to you, this account shows on the credit side everything the partner's earned, and then on the minus side, whatever the partner's taken. Now, in both cases here, both partners ended up with debit balances, which means that their earnings were below their drawings for the current financial year. They took more out of the business than they actually earned. Okay, the only other videos I'm going to do on partnership ledger accounts is 2 past test activities with you. So I will do that the next time I record a video. Thank you.